Hey guys, welcome back to the channel. Today's video, we're going to be talking about the Fed holding off on a rate hike. This is what kind of everyone was anticipating. However, it seems like there could be one or even two more coming this year and how it is going to affect you guys. Now, the decision, of course, to really pause came off the numbers that we got. The CPI numbers were actually down a little bit. The unemployment numbers were still pretty good. But overall, when you look at their policy, they've raised the policy interest 5 percentage points. That is right, guys, 5 percentage points, which is the highest rate increase since 1980, which of course has really affected the stock market, has affected spending, pretty much everything across the board. Now, they're considering this a hawkish pause. So what that means that central bankers will take another 6 weeks, seeing the impact of policies that the Fed has put in place to fight inflation and see exactly what it is. Now, they left the target borrowing rate at the 5 to 5.25. As we know right now, we are at 5.25. So holding steady to see kind of what the impact is long term. Now, remember, any of the adjustments that they do make to the economy, it's usually, they say, roughly about 9 months before you see the impact of making that. So markets, of course, are going kind of crazy because it has finally come to the point where the Fed has skipped raising the interest rate, and there is a pause. So the S&P 500, if you checked out the article from Jamie Dimon over at JP Morgan Chase, he expects the S&P 500 itself, or the stock market in general, to go up 14.8% with the news of a pause. Now, with this, they're also saying that he is saying, Jerome Powell is saying a couple years before we see a reduction to try to get to that target, which I really don't think so, that it is going to be that much of an extended hold period. I mean, if you're talking 3 or 4 years for that hold period, that is going to be kind of crazy to see. Now, all of the dots kind of are showing a downward trend, which is the way that we want it to. Assuming that they move forward with a 0.25% increase a little bit later this year, or if they do 2 rate hikes, we're going to have to see exactly where that leaves us. Again, they need to slow down with these rate increases, which is where a lot of people are kind of getting underwater with, because as the rates increase, things get exponentially more expensive, which again is having a really, really long-term effect, a negative effect on people's abilities to actually afford things. Now, members also moved up the forecast for future years, now anticipating a Fed's fund rate of 4.6 in 2024, 3.4 in 2025. So again, moving into 2024, it seems like there is going to be an anticipation to rates coming down from that 5.25 down to the 4.6 in next year. Now, it doesn't make a difference really what month it is, but there's a point where it could possibly go lower, and then 2025 again going lower. So again, it shows a very, very strong, promising direction that we're going. Seems like the tough times might be a little bit over for some people, but not for all of them. Now, on inflation, they raised their collection projection to 3.9 for core inflation, which of course excludes food and energy, and lowered it slightly to 3.2 for headline. Those numbers have been kind of between there for a while at this point. The outlooks for subsequent years in GDP, unemployment, and inflation were left little unchanged. Now, again, Feds officially believe the policy that they're doing has long and variable lags. This is kind of the problem, guys. This is where, again, a lot of people have said they went too high too fast. We don't know exactly what the economy can bear, what the stock market can bear, and what it is going to look like. Now, after a year of inflation starting a dramatic climb, the highest level in 41 years. That is right, guys. Inflation was higher than it has been in 41 years, which is the reason that we really seen the change. But what is a result of this, guys? Now, it helped push the 30-year mortgage rates over 7%, also spiked the cost of all consumer items, auto loans, credit card debt, anything that is revolving. You have seen a significant increase to the monthly liability, to the monthly payment, making things a lot more expensive. Now, they've also said towards the end of it that inflation remains still elevated, so it's going to have to see exactly what the impact is, or if we're going to see those increases. So inflation in the U.S. economy, due to multiple COVID pandemic-related factors That is what they're kind of attributing it to, guys. The supply chain, strong demand for consumer goods, and a trillions of stimulus dollars. So the Fed in this article is kind of fessing up to what they did. So essentially, to keep the economy up during COVID in the time of uncertainty, they gave us trillions of dollars in stimulus packages, resulting in the buying power of U.S. citizens, Americans, to go up substantially. Because if you're working during COVID and then you got all these stimulus packages, all of a sudden it was payday, guys. You had an absolute crazy amount of money to go ahead and spend wherever you wanted to. Now, at the supply demand mismatches labor market a little bit, kind of push wages up a little bit higher. Looking to really correct the ship, as they say. And it's going to be interesting to see again what the impact is with the pause on rate hikes. Sorry guys, so that'll do it for today's video. Let me know in the comments what you guys think about the Fed's decision to hold off on the rate hike. And as always, thank you guys for watching.